So in honor of Charlie Munger, I wanted to do a video about the top irrational investing mistakes, at least what I think they are. I used Poor Charlie's Almanac as inspiration, especially that last talk, The Psychologies of Human Misjudgment. I'll link that talk. But what I did was I cherry-picked specific misjudgments that he referenced that I think pertain to investing. So I want to kind of take that talk and do a very investing specific version of it, right? I added some of my own. I hope you don't mind. If you want to comment any, please do. I'd love that. Also, do me a favor, comment your favorite Charlie quote or Mungerism. All right, so let's get started. The first one that we're going to go over it's actually two. It's doubt avoidance and inconsistency avoidance. So these are separate misjudgments in his talk, but I wanted to combine them. So the first one, doubt avoidance. We are programmed to really come to a decision quickly. We didn't evolve to sit and rationally go over all the different outcomes and make a decision because we were staring at, a predator or something like that. Like we evolved to make snap judgments, use our intuition, that sort of thing. And then there's this second piece here, which is the inconsistency avoidance. And you can see his quote, "The brain conserves programming space by being reluctant to change." Now, that's probably up for debate on if that's the mechanism, but it's definitely a true thing that we do not like changing our minds, okay? I think that the real kicker comes from understanding how these two ideas interact, right? Because what this is telling you is that if you don't really know something, your tendency is to quickly make a decision based on very little information and then stick to your guns no matter what, which is terrible, right? That's very irrational, especially with stocks. I think that we have a tendency, especially me, because, I record my opinion on things, is that we make a snap judgment on a stock, positive, negative, and then we're kind of forced in a way to stick with that original judgment. So just be mindful of that and look out for ways that you might be doing that and how to avoid it. Kind of adding on to that is the tendency to optimism, our higher self-appraisal, and confirmation bias. I think these all kind of go together. He talks about them separately, but like I said, I think that they all go together and kind of support that first irrational mistake. Basically, we have a tendency to look on the positive side of things. We have a tendency to appraise ourselves higher than others. He quotes an example in the book where he says, 90% of Swedish drivers rate themselves above the average Swedish driver or something like that. I think it's Sweden. But anyway, I thought that was funny. Confirmation bias, that's another one. We have a tendency to, even whenever we look at facts, to only pick out the ones that we kind of believed already in a way, right? And this is that very high-tech Venn diagram. And then he quotes this ancient Greek that what a man wishes, he also will believe, right? So the key there, I think, is to really look at the downside of your stocks that you hold. Or something Charlie always said is that you should try to kill one of your best ideas a year. I try to do that. I have my favorite stocks or something like that, and I try to look at, okay, which one of these am I wrong on, or which one of these do I need to kill this year? That sort of thing. I'm usually wrong a lot more than once a year, so I find something. But anyway, just keep that in mind. All right, next one. Invested time or sunk cost fallacy. So a lot of us have this idea, and that's what this comic represents, that if you try hard and you never give up, you'll eventually hit the diamonds, that sort of thing. But I want to speak against that for a second, because I think in a general sense that's true, but whenever you're looking at a specific stock and you're spending hours on due diligence and stuff like that, you have a tendency to want to be rewarded for that research. So in a way, and I'm super guilty of this, I appraise stocks higher that I've spent more time on, because like I said, you want to think, okay, I want to get something from my time that I spent on all this, so I'm spending this much time on it, it must be right? So, however, the truth is, I don't care how much time you spend on a stock, you're not going to change the future earnings, right? So again, you just got to be mindful that time spent does not necessarily equate to returns. Now, going back to this graphic though, I think in general, a broad search of stocks and just always looking, maybe not at one specific one, but turning over lots of stones is a good way to go. I'm talking specifically about going down the rabbit hole on one specific stock and then thinking that increases your chance of a higher return. All right. Availability and competency misweighing. So I love this quote that he had in the book. When I'm not near the girl I love the girl I'm near. Okay, so basically what it's saying is that we are biased towards using things that are in our proximity, and I'm going to expand a little bit to say in our competency as well. So I'll give an example of myself, right? So the chemical industry has really not had that great of returns. It's been cyclical, and there's usually highly competitive, no moat, lots of debt, that sort of thing. But I work in that industry, so I feel competent whenever I look at those stocks, and so I've probably overweighed my own opinion on it, and it's caused me to make some, at best, mediocre investments. So that's one example. I just think that that's interesting. Of course, I think the man with the hammer syndrome applies here. It probably applies in a lot of places. Basically, if all you know how to do is use a hammer, then you're going to try to solve every problem like it's a nail, right? So anyway, all right, that's that one. Next one is one of mine, and this is pattern recognition, or I should say the illusion that we have pattern recognition whenever it comes to things like stock price movements, short-term stock price movements, or general trends, that sort of thing. I'll give you an example, okay? You read any message board, and I'm sure you've thought it too. I've thought it too. You have this idea of, oh, they always underestimate earnings, and then they'll run up after earnings, or this time of the year this stock always does better, right? That sort of thing. Or they always drop down to, like, let's say $70 a share or something like that, but they never really go below that. So if you can get it around 70, you know you're good, right? That sort of thing. You know you're guilty of it. I know I'm guilty of it. In the back of my mind, I'm always trying to look at some sort of pattern, right? And I put the clouds there because, I mean, tell me, what do you see in that top cloud, okay? I'm sure everybody sees something differently. I mean, look, it looks like, to me, the top cloud looks like a baby sleeping, and you got a question mark over it. Okay, anyway. Okay, pattern recognition. And the quote there, the quote is from whenever I was a kid and played chess. That was what my chess coach used to tell me. He said, if you think you see it, it's not there. Because I was thinking I saw some cool sacrifice or something and going after that. And his point was, hey, look, try to think the inverse, right? Before you make the move, say, okay, why is this pattern not correct? Another way to think about pattern recognition in my mind is that the pattern's going to work every time except the times that it doesn't work, right? All right. Reward and punishment association. So this one's also pretty potent. I quoted Benjamin Graham here because I think that this is a perfect example that the stock investor is neither right or wrong because others agreed or disagreed with him. He's right because his facts and analysis are right. I think, was it Peter Lynch? I think that's Peter Lynch that said something like, stock goes up, I'm right. Stock goes down, I'm wrong. That's not necessarily the case. And I'm super guilty of that. I'm sure you are too. Think about how many times you've bought a stock. The next day it goes up 2% and you're giving yourself a pat on the back like, hey, man, that was a really smart purchase, Or the inverse where you buy something and it goes down 1% that afternoon and you're like, God, why were you so stupid? You just could have, that sort of thing. Completely irrational, and I know I'm doing it, but I still can't help doing it. So hopefully this helps me get rid of that, or at least minimize that tendency. All right. Another one that kind of piles on there is stress and social influence. Charlie talks about this in the book. He uses the elevator example, which I think is pretty funny. Basically, the classic experiment is that somebody gets in an elevator, everybody in the elevator is facing backwards, so they naturally face backwards right into the wall, even though there's no rational reason to do that. Your whole life, you get in the elevator, you face the way that the door's coming out, right? But social proof is pretty strong, right? And the key point here is that whenever you're under stress, you're way more likely to, I should say, submit to what everybody else is doing. So the way that this applies to investing is that when are you under the most amount of stress in investing? Probably whenever your stocks are going down, right? So whenever your stocks are going down, it's because other people are selling. And let's say, your company reported earnings and stock drops 30%. You think, first of all, you're super stressed. Second of all, everybody else is selling. So in your mind, you're like, oh, shoot, I better sell because everybody else is selling. That's a real tendency, and just be mindful of it. I try to avoid it too, but these all exist for sure in us. So the best thing to do is be aware of them, right? All right. Next one, contrast. We don't have an objective reference in our brain for most things, right? We judge everything on a relative basis. And Charlie Munger in his book says, a few psychological tendencies tend to do more damage. He gives an example of how we're usually willing to do the $1,000 upgrade on the leather interior if we're buying a $60,000 car or something. But if you already had the car and it was just, hey, you want $1,000 to make this leather, you'd probably not go for it, right? I think this one's especially important whenever you're doing a lot of stock due diligence. Like, let's say you're sifting through a bunch of companies and you're looking at 10, 20 different stocks, but you look at 19 terrible ones and one bad one. Well, you might see the bad one and be like, hey, this one's pretty good because it's way better than these other ones I looked at. But you do have to have an objective scale in your head, right? Now, that's not to say that there's no such thing as opportunity cost, but in general, you should know what good looks like in a stock, right? Okay. Anyway, next is a selling mistake, and this is going to be our underestimation of compounding effects. Charlie Munger calls it Lollapalooza effects, and I hope I spelled that right. Basically, he says we have a tendency to grossly underweight compounding effects. So we process things very linearly, and we usually think that things add together, right? When in actuality, most things usually compound. And Albert Einstein called it the eighth wonder of the world, I think. And there's debate of whether or not he said that. Now, Charlie Munger says if Albert Einstein didn't say that, he should have. So I'm keeping it as Albert Einstein. Anyway, I included the 3 graphs here just because I thought it's interesting. An exponential, which is the green line, will always beat out the linear and the polynomial. So just keep that in mind, even though this one's a 2 and the blue one's a 3 and the red's a 50. I mean, you can see it's really depends on where the variable is in the equation, right? I think this one's super important whenever you're looking to sell a stock. I think that as value investors, we do a very good job on the downside protection, but what we often do is underestimate the potential upside. So, for example, you might buy a stock at, 5 PE, and you think, hey, at this growth rate with this margin of safety and stuff, I should probably climb to about an 8 PE and earnings should grow about 10%, that sort of thing. So that's all great, right? But what if earnings grow 12% for the next 7 years? The PE jumps to 40 and they buy back 10% of the shares every year or something like that, right? Now that return that you thought, going to 5 to 8 was good, now that turns into a huge return, right? I mean, what is that? That would be, I'm not doing that math, but it's a lot, right? The upside is much bigger than people think, and you got to make sure that you're not underestimating that and underestimating in general compound effects. All right, last one, the use it or lose it tendency. And I think this one really applies to investing, especially valuations, because I think it's very important to always be valuing companies, reading 10Ks, doing discounted cash flows, that sort of thing, because you keep it really fresh and sharp. And what I've noticed is whenever I take a break from spending time on investing and I come back to it, usually there's some rust that I need to shake off. Like I usually make some assumptions that whenever I go back and look at it, I'm like, why did you assume that? That sort of thing. So just keep that in mind. The piano player quote is the one from the book. In general, if you don't use something, you lose it. And I'll end with tying this to, Charlie and Warren's age, right? I mean, I think that one of the reasons that they were able to stay healthy and mentally sharp is that they used their mind on a daily basis, right? They were always thinking. And I think that is a lot more important than people think in staying mentally young. Anyway, that's all I have. Like I said, please comment your favorite Mungerism below. I'd love to read them, be reminded of it. So hope you enjoyed the video, and I'll see you next time.